Let us all now give a very hearty welcome to Mr. K.V. Kamath for his conversation with Ms. Shireen Ban on India at 75 and at 100, the journey ahead. All yours.
Yes. You'll have to use the mic, sir. All three of them.
Hello. Okay, it's now live. Thank you, Bharat. I just want to say a few words. I didn't have the privilege of knowing Lalit, but I can say one thing, that reading all the tributes, he was a gentle person, he was a learned person, and he had this unique ability to get things done. That's what several people have mentioned. I think that's a rare combination, to be humble, to be gentle, to be learned, and a spirit of getting things done. So I also acknowledge all that he did. Before, I actually got into the banking business and into the development process that we have seen all around. So all my good wishes. And thank you for, this, looking after this foundation along with the trustees for all these years, and doing what call human service in getting the message out from the various people who have preceded me in delivering this lecture, starting with Mr. Wagul and spirituality. And I think today we'll end with India going to 100, with Shireen catalyzing the process. Thank you.
Well, thank you very much, Mr. Kamath. Good evening, ladies and gentlemen. What an absolute privilege and pleasure it is to be here to join you all for the concluding series of this 30-year journey in memory of Sri Lalit Doshi. I feel particularly privileged to be having this conversation with someone that I've respected and admired and spoken to over the past 2 decades. Just to take forward what we heard there from Mr. Doshi, Mr. Kamath, of course, as we've heard many times over, has been the perennial India bull. He's been a champion of the India story, but I got to witness that personally. In the early 2000s, we started a program in association with ICICI Bank on CNBC TV 18. It was called the Emerging India Awards. The idea was really to create a community and a platform for India's emerging entrepreneurs, for India's SMEs. And I remember way back in, I think it was 2005, 2006, Mr. Kamath said, India is not enough. We need to take these stories global. And we decided to take the Emerging India Awards, which, by the way, then became India's largest SME property. It has made it to the Limca World of Book Records as well. And we took the Emerging Awards to London to start with, and to many other international destinations, because he firmly believed that India's time had arrived and it was a story to be told globally. So I completely agree with you on his ability to take bold decisions and to be ahead of the curve. I know he's also a big believer in technology, and again, something that he has championed through the course of his career. And he's also been a champion of gender parity and diversity, and that I'm truly grateful for, Mr. Kamath. If we could tap into the brain power present here in this room, starting, of course, with Mr. Kamath on the stage, but also luminaries here in the audience, Mr. Deepak Parikh, Mr. Uday Kotak, Mr. Ganguly, Mr. Nambiar, Mr. Mahindra, Dr. Anish Shah, we would have the most appropriate and impactful blueprint for India at 100. And what a fitting tribute to Lalit Doshi to have all of these luminaries here in the audience to conclude this 30-year journey. But without further ado, Mr. Kamath, let me start by talking to you a little bit about the past, because as they say, you need to have a glimpse into the past to be able to connect the dots in the future. As we look at where we stand today, what have been the most seminal, the most transformative changes that have brought us to this past that you believe we will need to amplify and build on as we look at India at 100?
Yeah, clearly 1990 is where set the, I would say, ball in motion with the opening up of the economy. It took the Indian entrepreneur probably 8 to 10 years to come to terms with it. And then certain other things happened. Interest rates in around 2000, the government bond was at around 11.5%. So you wanted a home loan, you probably had to borrow it at 15%. A car loan was 18% and a motorcycle loan was 24%. We could not have gone ahead with those rates. I think at that point in time, the government addressed this. I think Vijay Kelkar was the finance secretary. And within a year, actually rates came down to the bond rate the 10-year government bond came to around 6 or 6.5%. Then suddenly everything became, got into motion. The mortgage dropped to around 8.5%, car loans 10.5%, and the motorcycle was available at the interest rate of 14%. I think that set in motion one cycle. The second cycle is that drop in interest rate also helped corporates to clean up their balance sheets and the banks to lend a helping hand, and along with certain key steps taken by the Reserve Bank. I remember Dr. Jalan was the governor. He brought in, we had a dialogue, and he had a dialogue with all of us, bank CEOs, and he introduced the idea of restructuring of credits which could be restructured. If it could not be, then of course you let it let it die, as it were. But most of the companies could be restructured. But so there was a restructured book and an NPA book. But with the drop in interest rates, and I would say a newfound competitiveness, the effect of opening up could be seen from 2000 onwards, when you saw the growth rates propel, along with certain other policies. So that opening up then rose through the 2000-2008 period. 2008-2009 is, I would think, the next step. When you had infrastructure come in. And a lot has been said about infrastructure, but I think we also need to factor in, it was a learning process for everybody, including if you see the rapidity with policy changed, policy reversed. So you, as a lender, somebody else as an entrepreneur, and the consumer, all were caught in this whirlpool. I won't go into the details, but we can map the number of policy changes that took place for a variety of reasons. So we had to face that challenge, but then that challenge got addressed starting 2014, and you had a new momentum come in. So I break this into the opening up in the early 1990s, then 2000, 2008, 2009, a period of rapid growth. Then slight, I would say, the economy stalled, as it were, and then it took off again thereafter. And during this period, 2-3 things have happened. Just to put this into perspective, technology changed. So if you look at the banking business, the induction of technology took place in the late 1996. Thereafter, it remained more or less stable. And then you had cloud. And now you have open source. So the technology movement is going on. Along with that, you had corporate India embracing technology. And to me, the most exciting part of this journey has been post, let's say, 2018 or so, 2019, the start of what I call Digital India. Probably as of now, 150,000 digital startups, which will be a major part of 75 to 100. We'll talk about it when you catalyze that process, as it were. But to me, that is where the technology, we will become a digital society and we will have transformation. Corporate leaders are already transformed. The layman has transformed. The person who could not use a phone today is using an app. And Digital India will drive the future. So there are these 3 or 4 phases. And of course, with all this, you have what I call intelligent AI. We'll discuss that again if you catalyze the process.
I will try and catalyze the process. And let me start with what you actually started your comments with, and that is interest rates. I'm not going to ask you about where you see interest rates headed in the near term, whether you see the MPC cutting rates in February or not. But what I wanted to start by asking you, as we look at India at 75 and India at 100, the way that we look at inflation, the way that we look at the framework to deal with inflation, and I know that you've had your own opinion on this in the past, but the way that the MPC has functioned and what you believe the need of the hour is as we look ahead, what would you like to put on the table?
Yeah, firstly, I think we have to acknowledge the work done by the monetary policy authorities in the country, because holding things steady over what I would call a turbulent 5 years, the last 5 years, was an impossible task, and they made it possible. And you come out of that with a very healthy economy, corporates which are in great shape, and the individual with the inability to pay, and so on. So they have done an admirable job. And I think they have done the right thing at the right moment. So I don't think that they could have done anything different. You are now asking me to look forward.
Yes.
I won't look forward, because again, that's a call that the regulator has to take.
Well, I'm not asking you to look at February, sir. I'm asking you to look more long term.
Yeah. Okay. Okay. Let me give you. I will give you data on that. And I will stick to that as an objective for 100. Let's take a growth cycle that we'll take two countries. We'll take Japan and China. Japan, when it started its transformation in 1970, inflation was 8%, interest rate was 8%, and the yen was 350 to the dollar. In 1992, 22 years later, and we are talking about 25, inflation was 1%, interest rate was 1%, and the yen was 90 to the dollar. So you see the ability of a growth cycle to take a country to a different path, not just in terms of GDP, but in terms of where what happens to inflation, what happens to interest rates, and what happens to its exchange rates. We are a much stronger currency. China, very quickly, I take a period 2000 to 2015. 2000, 8%, inflation 8%, interest rates 8%. The exchange rate was around 7.5%, if I remember, or so to the dollar. 2015, I take as the exit point, because after that, a whole lot of things have happened. Exchange rate is 6.5 to the yuan is 6.5 to the dollar, and interest rates 2%, inflation 2%. So I look at an India 25 years from now, where the rupee will be stronger than where it is today, and significantly stronger, and interest rates and inflation will be tending towards, I would say, the normal. Currently is set, let us say, at 4% or a band, but I think it will be at the lower end of the band. That's nearer 2% than 4%, the middle of the band. So I think, look at the past, look at what's in our favor, and the way we are driving momentum. I see an extremely a changing environment. And if I use those two yardsticks, we would be where they were in terms of all parameters.
But, in terms of the policy prescriptions, to be able to get to that kind of benign inflation of 2% as well as an interest rate of close to that as well, what are the policy prescriptions that you believe we need to work on today between both the central bank as well as, what people are doing in North Block? I mean, what will be the imperatives to drive us to that point?
There's a single imperative: drive growth, and drive. Whatever is required to drive growth has to be done. And I don't necessarily think it is moving interest rates too much. Indeed, any interest rate where the borrower is going to pay up in double digits is not going to get you that growth. So interest rates will have to be below, and we have seen it in the 2000-2008 period. Interest rates had to be bearable. The layperson has to pay between 8% to 9% for a mortgage, 10 to 11% for a car. Then things happen, and industry also. Between 9% and 11%, things happen. But the moment you go beyond 10%, you have a challenge. So I'm sure that is what is being kept in mind. And we have had right through COVID and thereafter, I think that sort of an environment. I would believe it will continue to happen.
Well, let me start by talking to you about the prescription and the roadmap as far as the financial services sector is concerned, because that is a sector that you know best. And let me start by talking to you about the role that you believe Indian banks will play as we move forward, and what you foresee now as the future is concerned for the banking sector. Do you believe we have too few banks? Do you believe we need more banks? Do you believe there should be more competition? Should the Reserve Bank be giving more licenses out? What is the view that you have as we look at the next 25?
See, the way I look at it is very simple. Again, I use global examples as to what will happen. The banking sector, the financial sector, if you look at in our context, you've got the banks, you've got NBFCs, you've got fintech players who want to be banks, who want to be players in the system, intermediaries in the system, and you've got the capital market. So I would think that the next few years is where the capital market will start to actually propel at a faster rate than the other sectors. For the reason that this type of savings that get into the capital market are happening at a faster rate today.
Yes.
It's pensions, it's insurance, and so on and so forth. The type of instruments that the capital market can, can bring to the market. The market can, for example, we look at long-term instruments, which are appropriate for corporate India. But the banking sector tries to provide long-term money by term transformation. You take your average maturity is 1 year. You then try to transform it into 8 or 9 years. That's inefficient. So if you have the capital market able to provide that maturity, because that's the demand on that other side of the table, then you've got an efficient system. So this will happen over time. It won't happen tomorrow. So the retail sector will be primarily catered to by the banks. Banks will be still deposit-taking institutions. I think in the middle will be the NBFCs and fintechs, who will try to pump in technology at a probably faster rate than banks. So banks will have to do catching up. And it's good for everyone because there will be more competition, there will be greater. But ultimately, as far as the banking sector is concerned, this is purely my perspective. You'll have banks which will bulk up. And if you look at globally, including whether it is finally China, it's 15-year experience. You will need for an economy which goes from 4 trillion to 8 trillion. I look at ourselves as an 8 trillion in the next 5 to 6 years. You will need very large banks. The size of banks that we have today will have to expand dramatically. The good news is Indian banks now are running an ROE of upwards of 15%. So they are to me almost like a perpetual cycle engine, which doesn't need external funding, because the question would have been, yeah, they need to bulk up, but where is the capital? This capital need is very large. But I see Indian banks running a 15 to 20% ROE. That's good enough to grow at a healthy rate and meet the size of bulking up. Because every 5 years, or what is it, at 20% every 3.5 years, they will virtually double.
So, on the question of bulking up, do you also see consolidation as being a possible road to bulking up and getting that world-size bank that we've been aspiring for?
This is, I would think that it happens. It just happens by itself. Nobody needs to actually get to drive that this is the way you go. It happens. Business leaders understand what is the next imperative and they'll take that step. And I'm sure at that time the policymakers also will say this is for the good of the country and support it. In whatever means, either growing organically or through a process of mergers, bulking will happen.
Speaking about regulation and regulation keeping pace with innovation, and specifically as far as the banking sector is concerned, two questions as we look at the next 25 years. Do you believe that regulation should allow a fintech, for instance, to be able to get a banking license? I mean, the founders of Zerodha in their conversation with me said, we want to be a bank. If we could apply for a banking license, we would do it tomorrow. Do you believe that should be something that we consider as we go forward? And two, allowing corporates into the banking sector. This has been much debated, much talked about, much asked for as well. Do you believe that the time has come to perhaps consider that possibility?
See, we need to understand this whole question from the perspective of the regulator. A regulator, primary purpose on the banking front is safety of deposits. So when the regulator feels that there is comfort in fintech or a digitech coming in and becoming a bank and taking deposits, for which finally the Reserve Bank or the regulator is going to be responsible for, at that point of time they will allow this to happen. So clearly it's a transitionary process. So as that confidence builds up, that change will happen.
But what does your gut tell you? I mean, if you were to take that call today,
I think,
on the back of what you're
seeing, to be very frank, it needs a little more time, because I am seeing signs of rash behavior. I'm being very frank about it on the part of digitally driven enterprises, which I think the regulator has had to manage with great care. If you look at it as a bank, as a banker, if a regulator says that on, say, retail unsecured lending, I have to increase risk weightage by 25 bips, to me it is a signal. Or if another regulator says that 90-95% of F&O transactions are basically where people have lost money, and maybe 60 entities on the other side have made money, and that this funding has come from where? It has come from somewhere within the financial system. And I think they are not amber flags. They are red flags all over the place. So the regulator has to be careful. I think in the context of corporates, I think there is a different view that was there. These things that I mentioned will be relevant, but also is there going to be what I'd call lending to self?
Conflict of interest.
Yeah. So I think the regulator has to be comfortable with these things before we proceed. But to me, the first step is bulking up of existing players.
Is there room for privatization of banks over the next 25 years? Do you believe that there is political will or political capital, even though we've got the legislation, in place? Do you believe that there is political will or political capital?
I don't want to go down the route at all. What I'll say is, if public sector banks are going to run an ROE of 15 to 20%, they should thrive. So why should we need to privatize them? If give them more freedom, but make sure that your ROE is 15 to 20%. To me, that is the holy grail.
Okay, that's as far as banking and financial services is concerned. Let me now move to the next engine of growth, which is manufacturing. And a lot is being said at this point in time about this possibly being India's breakout moment or breakthrough moment as far as manufacturing is concerned. While we have made some progress, we're still nowhere close to that aspirational number of 20-25% of manufacturing share to GDP. Mr. Kotak's here in this room in a conversation with me a couple of weeks ago. He was very clear that the time has come for India to open up its manufacturing sector. In that same conversation, Sajjan Jindal said that no, we cannot. Indian manufacturing is still pretty much in its infancy. It's pre-teens. It's not even at its teenager stage. So if you look at the next 25 years, what should the manufacturing policy be as far as India is concerned to propel growth and drive investment?
I will put manufacturing approach it with a slightly different perspective. When does manufacturing thrive? Manufacturing will thrive when there is demand for products. And when is there demand for products? There's demand for products when the consumer has money in his or her pocket. So I think whatever is required to put that money into the pocket is the first step. And thereafter comes the question of should manufacturing be done through domestic companies growing at a faster rate or opening up the whole area. So if I look back, we talked about 2000. What drove, whatever we saw the momentum that happened? It was money in the pocket of the person. So you could afford to buy, supported by judicious lending at that period of time. So that created the cycle of demand, and you then had people open. Then the manufacturing sector started to drive at a faster rate. That has to happen now. So what will drive it today? So to me, that's a relevant question. To me, that will be driven primarily by investments in infrastructure, and there is such a lot of infrastructure to lay out. That is the Amrit Kal period, 20-25 years. We have enough to do. That will drive the momentum in terms of putting money into the people's pocket of the people, and that will create aspirations to have certain things, which will drive the manufacturing sector. At that point of time, whether the manufacturing sector domestically can meet aspirations and demand, or it has to be opened up, I think we should look at it at that point in time. Today, I think our entrepreneurs are well capable of scaling up. But if there is something new, yes, we should allow competition to come in. Just to put in context on that point, there's always this point in the media, out there, as to, no, I should not say media, out there, as to is there, why is investment not happening? It's a very simple thing. When I started my career, I did my first loan, giving money for a synthetic iron oxide project. Today's winner was a synthetic iron oxide project. My first loan was to a synthetic iron oxide project. To implement a project was 4 to 5 years. You had several steps. To import an piece of equipment was 2 to 3 years. Doing a balancing project or a modernization project was 2 to 3 years. So you talked of 5 years to implement a project. Today, a project is implemented in 2.5 years maximum. And marginal capacity increase through various things in less than a year. So companies are able to create capacity just in time. They don't need to create capacity much ahead of time. And that's why we don't see outlets at the pace that we were used to in the past. So to me, corporate India is a very efficient machine today, and they will grow. But at some point of time, need to bring in, let's say, certain things we don't have the technology or whatever reason, we will have to open up at that point.
You brought up the issue about the consumptive capacity and the consumptive power as far as the consumer is concerned. So let's address this issue even in the context of private capex. And what we've seen, commentary coming in specifically from the chief economic advisor, for instance, saying that corporate India has never had it as good as it does today, both in terms of a strong balance sheet as well as the kind of profitability that they are seeing. The concern, though, is that wage growth, in the view of the government, and I believe they've done a study with FICCI, the wage growth hasn't kept pace with inflation. So when we talk about consumptive capacity, consumptive power, what do you believe is the need of the hour over the next 25 years? You know, we've toyed about the idea of a universal basic income, whether that is possibly the road to take. We've got various schemes being put out by various state governments at this point in time. Whether that's fiscally prudent or not is the question. I mean, what do we do in terms of discretionary capacity, in terms of consumptive power as we move along? What is it that you would like to put on the table?
Your first point that you made, that sector, that is organized labor and maybe the unorganized labor, I think they have to get an appropriate wage, which keep pace with inflation. How does the corporate do that? Corporate does that, or will have to do that on a continuing basis through squeezing out efficiencies. I think the first squeeze out of efficiency that I have seen in my 55-year career was in post-COVID. The sort of improvement in profitability that happened because companies were able to produce, say, 100 units now with 75% of its labor force because they had no option because people had gone back to their village and not come back. So you brought in automation, you change certain processes, and that productivity increase has to go through and continue, and that will allow you to improve the wage of your worker. So that's the first step. The others all follow. But if you are going to work with your workforce always underpaid, that's a zero-sum game. That's not going to work out. To me, that's the first solution. All others follow.
But do you believe that this is a problem at this point in time that requires redressal?
I have not analyzed it. I am out of touch in a way. But the solution is you earn more, you pay more. And they are already earning a good deal. Very simple thing when you say already earning. State of the balance sheet of corporate in the year 2019, 2020 and 2022, 23 is completely different. They were all completely deleveraged. The top 500 companies in the country hardly have any debt, which means that they generated profits, they have repaid the debt and are running in a very healthy manner. Today, I think the next thing is to make sure that your employees get their due.
Well, that's the message that you're sending out to corporate India, and I think that that's the message the government is attempting to send out as well. But Mr. Kamath, I also want to address this issue about creating a social safety net or a social security net as far as not just the bottom of the pyramid is concerned, but also looking beyond that. And I bring this to you in the context of what we are seeing with various state governments rolling out many schemes largely focused towards women at this point in time. But do you believe that there needs to be a federal scheme that the government considers, looks at this point in time to address, adding that consumptive capacity? Do you believe the universal basic income is something that should be considered, for instance?
Shireen, I think basic consumption, what you said consumptive capacity. I think a livable wage is a must. There is no question on that, about that, in whichever form. But to me, for the mass of Indians, what is required is the ability to convert savings to investments. They have the ability to save, but that is not or was not getting converted to investments. Slowly, I think that process has started, and that should accelerate, where probably you can look at that investment going into his retirement, enabling him to retirement in So there are steps being taken. Time is too short to discuss those, but I'm sure it will happen. First is there is education required, that there is a product which you can invest in. It is easy, and looking up what you put into that investment is as easy as opening WhatsApp and reading a message. Then the mind will start changing, and you can do this experiment with your household help. You try to explain to them what is a SIP and tell them how easy it is, and they can actually now have an app where they can, Mutual Fund Central. You press Mutual Fund Central and you will see your balance. They will, the younger person will say that I will want to open a SIP. So we have to, those are the things I think which will be game changers.
Do you believe that there is a structural shift now as far as deposit mobilization is concerned? Is this generation of bankers going to have to fight very hard to get deposits?
Yeah, it's not a question of fight. It is a question of appropriate deployment. So ultimately, money, if it is not somewhere trapped in the system, will come back into the banks. So the instrument, saving instrument may be different, but from there, the money will flow back into the banks unless it gets trapped somewhere. To me, so the bankers, I think, always will have to be in terms of getting more efficient, giving new things to the customer. That they will do. Not a problem.
You talked about WhatsApp, sir, and WhatsApp is ubiquitous with technology in India. So let me ask you about what you see as the next phase, the next wave as far as the Digital India mission is concerned. We've seen what UPI has been able to do as far as transactions are concerned, what UPI has done in terms of allowing microtransactions and unlocking that economic value is concerned. What do you see as the next wave on the Digital India front? What would you like prioritized over the next 25 years?
I think we are working in several what I would call universes in terms of technology. There are people who are just just getting on the technology bandwagon, as it were. And I would say that a lot of banks are still there. They're still just getting on the technology bandwagon. The reason I'm saying is they are using technology of the 90s. Thankfully, they're not using mainframes, but they are doing the next thing, which late 90s technology. Thereafter, several things have happened. So that is bypassed. As it is happening now, you have got AI, and everybody talks of AI. But no, we need to take it in steps. You need to get up the technology curve, and then look at it in terms of how quickly can I do something else. But that's where competition is going to happen. Now, you named people who want to get to be a bank or what. If they bring in the sort of technology which the customer is going to scream for and say, I want it, then I think regulators will have to look up and say, no, we need to look at these too. See what has happened in the last 5 years. The regulator has been very open about allowing technology. They have allowed new things in a sandbox, which I never imagined they would allow. These were bold steps. I compliment the regulator for these steps, and I'm sure the regulators will continue with this. So we will have an interesting time in terms of older institutions, not necessarily in the financial services business, trying to play catch up with the new things that are coming in. Even as they have to replace what they have, something new is already there. And again, everybody talks of AI, but nobody is yet talking about what happens when AI gets to be intelligent. Today's AI that we are using, it's not intelligent. It cannot make a decision. It can probably analyze things and do this. But if it were to, let us say, when I say intelligent, AI learns to lie. It lies to you to get things done.
It hallucinates already.
No, it's not hallucination. Now I'm talking about lying. So when it lies, then the fun and games start. And you have this classic example, which I think Noel Harari that I mentioned, where using chatbot 4, basic level, the bot was told that you have to actually solve this CAPTCHA, do what you want. So it's a robot, so it can't solve the thing. So it thinks that I need to hire a human to actually solve this CAPTCHA. So it goes to the marketplace, and they name which marketplace it went to, and tries to hire a human. The human is actually an ethical person. So that human says, no, are you a robot? That's the first question the human asks. Now, AI, the chatbot, lies. It says no. They just figured out if I say yes, this person will not solve it for me. So this is paid solving. It's going to pay the human for the solving. So then the human says, so this guy says no. So it's a human at the other end. Then the chatbot asks him, the AI chatbot asks him, but then why do you need me? Why do you need the human to solve it? Then AI chatbot answers, I am visually impaired. Now there are multiple levels of lies that have come out. This is at early stages. So you can imagine what will happen as we go along. So I don't want to talk about dire tomorrow, but
no, it's not dire at all. So we're faced with this reality.
These are the things we will have to configure in every single business, not just financial services. Every single business that we are doing.
Well, yes, the tyranny of the algorithm is something that each business will have to contend with in the near future. if not already. But, you talked about new businesses and you talked about new ideas. Let me ask you this in the context of what we're seeing happen as far as India's startup ecosystem is concerned, which is now evolving and emerging as a new engine of growth. You also talked about regulation, and you said if the customer wants it, the regulators will have to oblige. Quick commerce. Nobody thought that 10-minute delivery would be possible, and yet it is uniquely an India story that has been a success story at this point in time. We've just seen the blockbuster listing of Swiggy and what Zomato, etc. are doing. As you look at how this ecosystem is emerging, the ideas, the innovation, the valuation to wealth creation journey, what gives you confidence? What gives you hope? How do you see this playing out?
Yeah, you see, I'll start by, you mentioned the regulator will have to listen. I said that. But what I meant is the regulator is already listening. As if you look at the sandboxes of the last few years that our regulator has brought in, the regulator is one step ahead of all of us. So that's a huge, for me it's huge. So the challenge as we go along is, who do you look at as your model? If you are a financial sector player, if I am a financial sector player today, I would not look at another bank or another financial service company. I will look at what Swiggy is doing. See, when Swiggy started and I started using Swiggy during COVID, Swiggy, the back end was a human. And slowly the human went out. Today it's an intelligent machine. That intelligent machine tells me that, I have a change in order, your refund will be back in your account. Yeah. It used to say 7 days. And the next minute it will be up. Still now it is saying it will be in your account in the next few minutes. But it's so that's the level of efficiency that is there without a human. So that is what everybody will have to aim for. Not only financial sector players, but other players also.
Yeah, consumer expectations have been disrupted and changed completely on account of this. But since we're talking about regulation, we're talking about the future, and what we've seen happen with the cryptocurrency, for instance. I mean, a new lease of life, record highs for the Bitcoin on the back of the Trump rally that's going on. What do you believe India's position ought to be on issues like cryptocurrency, etc., as we move forward? Do you believe the time has come to recognize them as an asset class or not?
Shireen, I'm very old. So,
you're not old at all, sir. No, you're not old at all.
I am very old. So I have to have some, I still cannot as a banker get it out of my mind that, how do you value something where there is no underlying? We have a phrase, there are eminent bankers here. Where there is no underlying, how do you value it? So I am still at a loss trying to come to grips with Bitcoin. Maybe I'm wrong, but I would stay in my corner for the time being.
You will stay in that corner, and there are many people in that corner, Mr. Kamath, including the former Reserve Bank Governor Shaktikanta Das. But you talked about AI and technology, and let me ask you this in the context of the big challenge and the dilemma that India will have to face: jobs. And jobs of the future, and the kinds of jobs that we are going to prepare our workforce for. What worries you there? We've been talking about our demographic dividend, our demographic advantage, our young population being the talent base for the world, and so on and so forth. But as you look at the future, what do you believe is the challenge that both the government as well as the private sector will have to deal with?
Yeah, Shireen, if we look at least a 20-year runway where we have to take our economy from, say, 4 trillion to 50 trillion. I think jobs are not going to be a constraint. I think at some point in time, in this phase, it will be, do you have the young workforce to actually get to that number? So I wouldn't worry too much about it. But
it's a problem today, sir.
But but that problem is a different problem. That's a problem. Today's problem, as I see it, is that, so what needs to be done really is your entire education system has to be completely rewritten to prepare people who are relevant for today. That's not happening. That's absolutely not happening, and that's what's causing the frustration. So you'll have to rewrite the education tutorial, as it were, as to what are the steps that we need to take. And again, if you look at, this was done from 2000 onwards. The schools were revamped. Everything was revamped. Europe did it, leading on to this one. Europe continues to do it. If you ask somebody who has got children going to school, how does, say from age 7 or 8, how does the schooling system move? He'll explain to you what happens. But we need to put that in rather than put everybody in one crack, and then create a problem where you really have a situation where you can't employ the person. And our situation was that you could not employ even the technically qualified. So you had an engineer who had to be retrained for at least 4 months, or trained actually, before he could be put on the job. You cannot have that. So we need to rethink curriculum right from, I would say, KG to graduation, and prepare people for what they need, what we need tomorrow.
You're talking about reimagining education in an era of AI and so on and so forth. Let me ask you a broader question, Mr. Kamath, about the role of the private sector over the next 25 years and the public-private compact, so to speak. What do you believe this partnership needs to look like to be able to deliver on the promise, the potential, as well as the challenges over the next 25 years?
Yeah, it has to be a partnership as we go ahead. And you would need to, whatever handholding is required to get the public sector to be able to do what the private sector does. I am 100% sure they can. But that handholding has to be there. And whatever are the constraints you see that they have, those will have to be eliminated to get them to be efficient. My own experience at NAPFID is that with a public sector team, you can do as well as a private sector team. I can say it openly and loudly. You remove those constraints and they will perform certainly equally, probably better.
What are the key constraints? What are the key deterrents that you believe need to be removed? What are the big obstacles?
I think the process that has been laid down, the checks and balances that have been laid down, which I think are unnecessary. You need to, in today's world, have a different set of checks and balances. If the checks and balances that work in the private sector can be put in there, they should also work. Why go beyond that? So you'll then end up in what I call suboptimal decisions. So if you can implement technology at 10 crores, why should you then be forced to go through a system where you may end up implementing technology at 10x? So these are the sort of things that arise.
I want to get your views on what we're seeing happen globally at this point in time. There is a big geopolitical shift that's taking place, and it is a volatile world where new relationships are emerging, old relationships are fractured. As you look at India's place in the world, in an era where we seem to be retreating from globalization, we seem to be retreating from multilateral institutions and multilateral organizations, what do you believe the role of India will be, and how do you believe India should tread in a global environment which is shifting and changing so fast?
I think so far we have done that admirably well. And to me, India's role will be increasingly more important in a global context as we grow. Nothing matters today as much as muscle, and that is financial muscle. And as you go from 4 to 8, 8 to 16, you will see others respecting that muscle. And I think on all other fronts, anyway, we are, I think, doing as well as anybody else could do. So I see people looking out for partnerships with India. India probably need not have to go there and hunt for partnerships.
So the economic muscle will be the calling card?
Absolutely calling card. Absolutely the calling card.
The future for multilateral institutions like the BRICS Bank, for instance, for the WTO, do you believe that that we're going to see a seismic shift, a seismic change in the role and relevance of these organizations?
Let me be frank. There are some institutions which I think they'll have to carefully evaluate whether they have a role. Like you mentioned the WTO. You see what's happening.
You believe the WTO is not relevant any longer?
They can't take decisions. Their setup is not complete. There are people not appointing, not allowed to be appointed. All sorts of things are happening. So, which means that it's an organization which probably was relevant at a particular point in time, may not be relevant as much.
So what should that be replaced with? I mean, do we need a rule setter, so to speak?
It's now going to be free markets. Everybody is driving free markets. Everybody is whatever be the role, I think it is now, it's observed in the breach rather than in. But let's come to the BRICS Bank. The BRICS Bank, I think, or coming together of countries in the South was bound to happen. I think there was prescient on the part of the leaders of that time to say that this is what we are going to do. And to me, the biggest surprise was when New Development Bank was set up, and we had 5 members. There was one member with an A rating, international. India with a triple B minus, still investment grade. Other three, not investment grade. So what would a common person with some knowledge of financial markets say should be the rating of this institution? Certainly not a triple A. So what? So we ended up getting a double A plus. So to me that clearly showed that in unity, when you are united, there is enormous strength. And we could borrow just about 10 bips, 15 bips higher than the World Bank, which you could very easily solve through a very lean organization and using technology significantly more and so on. So being from the South is no longer a disadvantage if you all come together. So to me, these institutions are required, particularly where the South is concerned. And which is not known. There is also the BRICS currency reserve, which is not talked of.
Which Donald Trump has already threatened to go after.
No, this is a BRICS. No, this is not the BRICS currency. This is a BRICS currency reserve, which is basically a parallel IMF, which it's not in the public domain, but it is there. It doesn't have an office, but it runs out of. It is in readiness to meet the needs of the BRICS countries if ever they have a need, where they have a crisis. So these are steps that are taken where I think countries from the South are preparing themselves to maybe say that we have a role in the new order.
Well, speaking of a role in the new order, Mr. Kamath, I think we're pretty much coming to the close of our time. But you talked about the 55 years of your career and how you've actually seen the growth and the evolution and the change as far as India's entrepreneurial zeal and entrepreneurial aspiration is concerned. As you look out today, what would you qualify as the risks that we need to be mindful of, but also the message from your own experience to Indian entrepreneurs who are looking at big bets, bold bets, audacious bets?
I'll only say, I convey good wishes to you. Please continue.
Is this the time? Is this the time, though?
Absolutely. Whether it's whether they are.
If you were back in the bank, what would you be underwriting today?
Anything that comes in front of me, as long as I find that it makes sense. It has to make sense, right? So if the cash flow is right, because firstly you'll have to look at, is this going to make sense in a 20-year horizon of the new India, which is a 20-year horizon. We're talking of already probably a 32 trillion economy. Does it make sense? And I think most things will make sense.
Most things make sense. Any sector in specific, any business idea in specific?
But there will be people who will...
minus cryptocurrencies, of course, which we've established.
There will be companies which are not leveraged properly, not structured properly, governance issues. Those will certainly be a red flag for a banker. I'm saying other things being equal, the opportunity to grow is so huge that a banker will have very little reason to say no to a project. But for these usual things, you structure it wrongly, you don't have the right people, you know that there are governance issues and so on.
You made the journey from 3 trillion to 50 trillion look very easy, Mr. Kamath, and it is going to be an arduous, complex task as we look ahead, with all stakeholders having to put their shoulders together to ensure that we get there. It's a matter of arithmetic at what point we're probably going to get there. But let me ask you this as to what could possibly derail the journey that we need to be careful about? Let's close with that.
There are 2 or 3 things that could derail it. I think the biggest risk would be a global, continuous challenges on the global front will wear you down. So that could be, and some of it we have seen in the last 2-3 years. So we have, I think, shouldered it pretty well. The second is, is the domestic equation going to be disturbed? Doesn't look like that. But these are the typical risks that could happen. But I would think the global order challenges there would be probably, you are the victim of a fallout, as it were, of that sort of a situation.
Mr. Kamath, I'm going to end by asking you, what has been your biggest lesson that you've learned over the course of the years, both as a professional as well as in your personal life, that you would like to share with us? What is the one thing that you that is your guiding compass, so to speak?
Yeah, my guiding compass is very simple. That you never know, what you ought to know. So keep learning, keep learning, keep learning. And I was taught that right on my first appraisal in ICICI Bank by Mr. S.S. Mehta, who was our general manager at that time. And I mentioned synthetic iron oxide. I still remember what I wrote in the appraisal. I used a phrase called synthetic rouge. Maybe they will understand what I'm saying. So Mr. Mehta was a chemical engineer. So he actually underlined every single place where I said synthetic rouge and said, on top he said, is this word accepted in the chemical dictionary? Which I had checked, and it was. So when I talked to him, he was very happy. So my learning process started there, that don't take things for granted. Make sure watch. And it continues today with all these exciting things happening. And the only thing is that we hope you will continue to learn as you go along.
Well, a lifelong learner, and speaking with you is always a learning experience. Many, many thanks, Mr. Kamath, for joining us here this evening to take us through your views and insights on what India needs to do in order for us to be able to get our place in the global order over the next 25 years. Ladies and gentlemen, a big round of applause for KV Kamath.
And let me thank Bharat and the trustees for giving me this opportunity. I think a rare honor to be here with you all. The 30th lecture, and what Mr. Wagul kicked off. I'm here today sharing my thoughts. Thank you. Thank you, Bharat.
Thank you, sir. Thank you so much. Thank you very much, ladies and gentlemen.